Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. In my last video I said that gold would go up, but it has gone down. So we're going to explain that. So from here on we saw that gold was going up, but on, 6th of November, we had some great news about a vaccine that was 90% efficient and that crushed the gold price to this level, and we have seen it go down more in November, but it has rebounded. Now, I agree that a vaccine is very good news for the economy because that means that businesses can open again, GDP will go up, and there will be no fear anymore. That will, of course, mean less stimulus and less money printing, and that will be bad for gold. But the fundamentals are still the same. The debt is still going up, money supply is still going up, and I will show you that. So I fully expect to see a larger rebound in gold back to the 1900 level in the next 2 months. Let's take a look. Just want to show you here what this aberration looks like. Because when you check, for example, the TIPS bond yield, which is inflation adjusted, you can see that this has actually gone up instead of down. So the blue line here is going up, while the gold price has actually been going down, which is not normal. So we are seeing a large arbitrage spread opportunity here, and either gold will go back up or we will see this TIPS here going down, which means higher bond yields or lower inflation. So this spread will probably narrow in the coming months. Now let's go over the gold and silver checklist. The latest data point on the gold forecaster index is positive. You can see that here on this chart. Latest point for October is up. So that means gold should be moving higher. Taylor roll rate hasn't changed. Misery index has gone down a bit, so that's negative. The unemployment rate has gone down a little bit, so a little bit pressure on this front. Inflation has not been going up lately in October. We had a little dip in the CPI, so that's a bit disappointing for gold here. We need to see this going higher. On the demand front, we see that the GLD has seen outflows. So these are outflows from the trusts. Investors have been selling gold from the trust. So that has a lot of pressure on the gold price. The same in the COMEX, which is now flat here. So we had a rocket ship going up in demand, and now it's a bit flat. It's still moving higher, but not at the same pace as a few months ago. SGE demand is flat. Silver demand the same. It's flat. The Chinese demand for silver has been going up lately. So we are almost breaking above this upper resistance in the silver inventory levels in Shanghai. So this is probably positive for the silver price. We also had numbers from the central banks. We see that India has bought some gold in September in the last quarter. Turkey has been selling some gold. Kazakhstan bought, Uzbekistan sold. And in total, we had a small decline in central bank holdings, but it's pretty stable. US mint sales have been going up for gold and silver. so that's good. Premiums are still at 30%, have been slightly higher because of the dump in the gold price and silver price. In Shanghai, we have good premiums, so these premiums are moving higher, which means the Chinese are starting to buy gold. So this looks very positive to me. Gold premiums are also up. PSLV premiums are still low. COT report was not that good. Managed money, the same. I want to take a look at the lease rates now because this is actually very important. We see here that the lease rates have been moving higher. So what does this mean? We have this cup formation in lease rates, and the same can be seen here in gold, but inverted. So as these things move up here, then gold is starting to bottom out. When we get to the zero level, gold should have bottomed out. So we are almost there. The same with silver lease rates. Let's take a look. What I look for in the silver lease rates is this here, these peaks. Each peak will tell us that there will be a rise in silver. A peak here, rise, peak here, rise, and we have seen a very large peak lately in December, which means silver is going to go higher. Let's take a look here. Swiss franc was making new highs, so that means gold should go higher. Seasonality, we are in December, going into January. That's typically a very good month for gold, so I don't see any problems to get more physical. The technicals are breaking down currently, but I see a rebound soon. Let's take a look at the macro indicators. The balance sheet. So we know that the balance sheets keep increasing. The ECB is printing a lot of money. They will be adding more stimulus in December. That's the news. The Federal Reserve has not been printing that much, but I'm hoping they will come up with stimulus somewhere next year, and that would increase the balance sheet. Then let's take a look at the money supply. Here we have very important news. The M1 money stock, M1 money supply has gone up 500 billion. That's the green line here. Look at this green line. In November 16th to November 23, we have seen a rise from 5.7 to 6.2. That's 500 billion. When this happens, then M2, M3, MZM will also start rising in the future. So you will see the orange line go up, the blue line go up, and that will be very inflationary. So gold should be following the money supply. Then we had trade numbers. The trade deficit went up a little bit. When we look at the services and goods trade deficits, you see that services, the blue line here, went more into deficits, and also the goods trade deficits went higher. So both deficits went higher. You can see that also on this chart. The red line is the trade deficit, and it has moved higher, which means lower on this chart. And this is actually very telling because the import prices, the red line, are going up and the export prices are going down. So inflation is really coming to the United States now. This trend has not gone back down. It is still moving up. So we have a very, very big difference in import and export prices, which is going to tell us that trade deficit is going higher. Let's take a look at the producer price index and the CPI. The producer price index had recovered, but I'm not seeing it recover more. It should go back to zero level, and we don't see that yet. The inflation CPI is also going down here to 1.2%. And Michigan says that we have 2.6% inflation. So not a lot of change here. I would like to see this go higher. Then capacity utilization. If this goes up, okay, we see that capacity utilization is going up. So that should be an indicator that inflation will move up next month. So that's a bit of hope for gold bucks. Now let's take a look at Bitcoin. I just wanted to say something about that. Bitcoin is correlated to the US dollar. Okay, so the red line here is the inverted US dollar. So if it goes up, means that the dollar is crashing. And lately we have seen that the US dollar is crashing a lot. And you can see that it is correlated to a higher Bitcoin price. By the way, you can always click on these 5 crystal balls of me. You have gold, you have oil, stocks, bonds, and US dollars. For example, I click on the US dollar, then you will see what the US dollar will do. This is the index, the US dollar forecast index, the red line. You see that it is crashing negative, and that means that the dollar will go down. So this has perfectly predicted the crash in the US dollar. And I think that the dollar will keep crashing until it is at the 80 index. We are now at 90. Let's take a look at the bond forecaster. And the bond forecaster is the blue line here, the blue line. And you can see that it is going up. So that means that the bond yield, the 10-year yield, will be moving up. And this is also predicting perfectly what the bond yield is doing. Bond yields are rising, and we are almost at 1% now. So this is very useful. Let's take a look at the stock forecaster. We see here that the blue line is going up in positive territory above 0%. So stocks will be moving higher, and it's getting stronger and stronger. Let's take a look at oil. And according to the forecaster, oil will be moving higher. You can see that here the blue line has gone positive and oil is starting to move higher. So what does this mean? Oil higher, stocks higher, bonds higher, bond yields higher. That means that the economy is really doing well. Okay? Earnings are going up, GDP is going up, and we need to be in stocks. And also in gold because there is inflation. Just to give you more evidence, Yardeni upped his forecast for the stock market. So previously he said that the S&P would go to 3,800 on 14th of August. And now he is saying that it will go to 4,000. on the 20th November. So we see that there's still almost 30% of upside from here. And I believe that we will see stocks going higher at this moment. And even more evidence, the GDP Now forecast of Atlanta Fed says that we will have more than 11% GDP growth in Q4. That's a lot. So stocks will probably go higher. And how do I bet on this? When you see that bond yields are going higher, GDP is higher, China is doing well, and stocks are going higher, then you need to be in the miners, in the copper miners, nickel miners. Copper, nickel, aluminum are all going higher. Platinum, palladium have all made new highs. And I think that Vale is the best miner here to buy because they are supplying the commodities for Asia. And Asia is the place to be. So this is from 2016. The numbers are a bit different now, but almost the same. And they supply iron ore in that's used in transportation and construction, especially in China. And this is very correlated to aluminum. So aluminum prices are up, iron ore prices are up. So they will have a lot of earnings on this. Nickel is being used in batteries for EVs. That's also a new trend. EV vehicles will be the future. And the same for copper. You need copper for construction and electrification of EV and green energy. So this part will go much higher in the coming years. And also this will be going higher. Now Vale is trading at a PE of 5 or 6, which is very cheap. So it is not too late to get into this. So I have also been changing some of my allocation in the portfolio to growth stocks. So the conclusion is that we need to stay in gold for the inflation, but also look at growth stocks because stocks will be moving higher. And I'll see you in the next video.